Taxes always cross our minds with their own twist of complexity. And it's not unusual because tax matters can be complicated, especially for NRIs, since India has two tax regimes, old one and the new one. If you're an NRI and confused about which regime is better for you, then keep watching this video. Today we will simplify the old and new tax regimes for all you NRIs. Let's begin with the old tax regime. The old tax regime in India uses traditional methods of income tax calculation. It provides opportunities for deductions and exemptions under various sections of the Income Tax Act. These include HRA, Section 80C, which is the tax saving investments, Section 24 deduction, which is home loan interest, and others. If you choose the old tax regime, you can find flexibility in tax planning by utilizing investments and expenses to lower your taxable income effectively. And what is the new tax regime? The new one was introduced in 2020 budget. It is a simplified tax structure with lower tax rates, but opting for it means giving up on many deductions and exemptions that are available under the old tax regime. Your Indian income of up to 3 lakh rupees can be exempt from income tax. However, tax rebates are not applicable for NRIs. Now let's find out the key differences between the two regimes. Let's start with the tax rates. If your annual income is up to 2.5 lakh rupees, then you will have to pay zero taxes under the old tax regime. If it's between 5 to 10 lakh, then your tax rate will be 20% under the older regime. For people with annual income above 10 lakh rupees, the rate will be 30%. Now let's move on to the new tax regime. If your annual income is up to 3 lakh rupees, then zero taxes for you. If it's between 6 lakhs and 9 lakh rupees, then the tax rate will be 10%. While the income between 9 lakh and 12 lakh, if you're in that bracket, the rate is 15%. But if your income is above 15 lakhs, then under the new tax regime, your tax rate will be 30%. When it comes to deductions and exemptions, the old tax regime allows deductions like ATC, ATD, HRA and others available under various sections of the Income Tax Act. Let's quickly take a look at them. Section ATC allows up to 1.5 lakh rupees. Now this includes children's tuition fees, the premium for insurance policies, ULIPs, ELSS and principal payment of home loan. Section 80D includes exemption on a premium on medical insurance of up to 25,000 rupees for yourself, your spouse and your family. It also comprises 25,000 rupees for parents and for senior citizens. The limit is 50,000 rupees. Section 80CCD 1B has an additional exemption of NPS of up to 50,000 rupees. Section 80E includes exemption on interest on education loans with no maximum limit. Section 80G is exemptions on eligible donations that qualify for an exemption of up to 50% or 100%, depending on the donation amount and to whom it was made. Section 80TTA exemptions on interest on savings bank accounts of up to 10,000 rupees. Section 24 has exemptions on interest on the home loan of up to 2 lakh rupees. Now the 2 lakh rupee limit is for loans taken for construction or for purchase. Remember, if it is for repairs or in case of the construction is not finished within 5 years from the financial year in which the loan was availed, the limit is 30,000 rupees. Section 80EE provides additional exemption on home loan interest up to 50,000 rupees, but there are a few conditions that have to be met. The deduction is only for individuals, meaning you cannot claim the benefit if you are an HUF, AOP, a company or any other taxpayer. Also remember, you should not own any other house property on the date of the sanction of a loan from the financial institution. HRA is also eligible for tax exemptions or deductions. To qualify for the HRA exemption, NRIs need to maintain accurate documentation like rent receipts and the landlord's PAN and so on and so forth, especially for rent payments which exceed 1 lakh rupees annually. You can take the help of online calculators to find out the exempted HRA. In the new tax regime, the deductions are limited, but salaried taxpayers can claim standard deduction of 50,000 rupees under the old and the new tax regime from FY24. The old tax regime can be more complex due to various deductions and documentation, while the new one is simpler as it has fewer calculations and documentation. Now, before you choose between the two tax regimes, there are a few factors that you must consider. First is taking your income sources into consideration. If you have multiple sources of income within India, such as rental income, interest from savings, or capital gains, the old tax regime might be beneficial as you can enjoy the deductions that it offers. Number 2, let's consider the deductions available. NRIs are sadly not eligible for certain deductions like those on property purchases. But wait, they can still claim deductions under Section 80C for investments like ELSS, PPF, and so on. In this case, the old tax regime can be better as you get to utilize these. Let's face it, we all dislike documentation work, and who does not want the ease of filing in complicated matters like taxation, right? So if you prefer a simpler filing process with fewer calculations, the new tax regime can be ideal for you. It's essential to consider the tax rates because tax rates sometimes can burden your wallet. Higher tax rates mean you retain less money, which can affect your savings, investments, and overall financial decisions. So compare the tax rates in both the regimes to see where you fall and which one works better for you. Sometimes the lower rates in the new tax regime can be beneficial even without deductions. So what you choose depends on your income levels, the amount of tax-saving investments made, and expenses incurred by you. In this table, we give you 3 income scenarios: 6 lakhs, 15 lakhs, and 30 lakhs, along with tax-saving deductions that you are eligible for under different sections, which amounts to 4,25,000 rupees, including a 50,000 standard deduction, which you're eligible for if your salary. The lower the income, the more advantageous the old tax regime would be. Therefore, it's advised to make the necessary tax-saving investments and pick the old regime. But for NRIs with higher income falling in the higher tax slabs, new or old regime may not make much of a difference in terms of tax implications. Hence, you may not need to make any tax-saving investments and simply opt for the new tax regime. Let's talk about retired NRIs now. It is crucial to manage your wealth and taxes properly after retirement. So if you're retired and you're relying on pension or interest income, then the old tax regime will be good for you. With this, you can claim deductions on certain expenses. Here are some practical tips for NRIs that will come in handy when choosing between the old and the new tax regimes. Number 1, calculate your taxable income. How to do that? Use online tax calculators to compare the tax payable under both the regimes. Number 2, you must review your investments to determine whether you are utilizing all the possible deductions allowed by law. Do check if you can fully utilize the deductions available under the old tax regime to save your pocket from a hole. Number 3, change is the only constant in life. Similarly, law changes are the only constant in taxation. Tax laws undergo frequent changes, which can have significant implications. Staying informed about the latest updates is crucial because these changes may impact various aspects of your financial decisions, such as your investments, deductions, and compliance requirements. If you stay updated, you can adapt your strategies effectively to maximize tax benefits, minimize liabilities, and ensure compliance with current regulations. Number 4, consulting a tax expert can make your life a lot more easier as they have an in-depth knowledge with regard to NRI taxation. A tax expert can guide you depending on your unique financial situation. So much information, right? Let's quickly revise what I mentioned earlier. India has 2 tax regimes, an old one and the new one. The old tax regime provides opportunities for deductions as well as exemptions under various sections of the Income Tax Act. The new regime is a simplified tax structure with lower taxes, but it does not include deductions and exemptions that are available under the older regime. The documentation related to the new tax regime is also easier. But please remember, it's important for you to conduct a thorough research to understand which tax regime is best suited for you. It's advised to consult a tax expert before making any decision. That's all for today. Hope I have been able to clear some of your confusion regarding the 2 tax regimes. But if you have more questions, feel free to drop them in the comment section below. And before you go, please note and remember that this video is for educational purposes only. Any information mentioned in the video is not an endorsement or any kind of an investment advice. If you found this video helpful, do not forget to hit like and subscribe to Groww NRI.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.